Welcome to this masterclass video on index investing or passive investing in equity. So a passive investment vehicle aims to track an index rather than beat it, and a successful tracker is accurate and relatively cheap relative to active management, where managers are trying to beat benchmarks and indices. So this has been a growing area of equity investment management since the global financial crisis of 2007-8-9. Active managers have found it more difficult to convince their client base, asset owners essentially, that their active management is their active returns justify the fees, the higher fees that active managers take. So certainly here in the UK, when you look at investment, the investment industry statistics, you see that passive investment has grown as a share of the overall professionally managed investment management space since the global financial crisis, which really reflects the knock to the confidence of investors and asset owners that active managers really do justify their higher fees. So this is an important area. It's not the racy side of equity investment management in that it doesn't involve forecasting, and it doesn't involve skillful methods with regards to predicting what's going to happen or finding inefficiencies in markets to exploit and to outperform. That's all the preserve of active managers. This is more about how do we accurately and at a low cost generate the same return as a benchmark, an index, or even a basket of stocks. So we are looking here at different ways of carrying out this passive investment. A modern approach to an equity investment portfolio is to consider the portfolio on a factor-based view. Now, that means we think about the factors that generate returns and what exposures we have to those factors. So from a passive perspective, we might try and match the factor exposures of an index rather than just buying the stocks in an index. If we are going to buy the stocks in an index in order to track it, that's a little bit more of a traditional approach. So there are more traditional approaches. We need to know the difference between full replication, stratified sampling, optimization. And remember, level 3 is very applied to a case. So it's very likely, if this kind of material comes up, that you'll find yourself recommending which one of those more traditional approaches to index-based equity investing is appropriate. And it will be driven by the nature of the index that you're tracking, most likely, and the size of the funds that your client has. Of course, in order to be accurate, we are looking at lowering our tracking error, keeping tracking error minimized. Tracking error, we might as well say it at the outset here. It's the standard deviation sigma of relative returns, RP minus RB, so returns of the portfolio over the returns of a benchmark. The volatility of that measure, that relative return, is your tracking error. And generally speaking, the lower your tracking error, the more accurate you are with regards to tracking. So we're going to be thinking about the causes of tracking error, the sources of it, and methods to control it. And then finally, in this section, there's a brief discussion about risk and return attribution. Now, you might not think that's a big deal for passive management, but of course, if there is any active return and tracking error, which, by the way, is another name for active risk, then we need to understand where it's coming from, what's causing it, and we need to think about whether we can remove it going forward, because we want to minimize tracking error in these passive-based approaches. Okay, so first up, we're going to talk about factor-based passive investing. So here we're tracking an index by matching in our portfolio exposures to well-known risk factors. So what do I mean by risk factors? Of course, these are well-known sources of